What if I told you there's a ticking time bomb hidden in the very heart of the US economy, set to go off around 2026 and trigger a financial crisis? This isn't just a wild guess. It's based on a signal from the Federal Reserve's own data signal that has perfectly predicted every single recession for the past 50 years with zero false alarms. Right now, that signal is flashing bright red. I'm talking about the yield curve, and it's been inverted for 21 straight months. That's the longest it's been upside down since the brutal double-dip recessions of the early 1980s that destroyed entire industries. The signs of stress are everywhere. Bank reserves are hitting lows we haven't seen since 2019. CEOs are hoarding cash at record levels. And the Fed just quietly hit the brakes on shrinking its massive balance sheet, which is a huge red flag that something is seriously wrong under the surface. So what keeps me up at night? The typical time between a yield curve inversion and the start of a recession is about 10 months. We are now more than double that. The last time the lag was this long was just before the 2008 financial crash, a crisis that wiped out 8.8 million jobs and vaporized $13 trillion in wealth over 19 brutal months. If history is our guide, we could be looking at a major meltdown starting around March 2026, and it could drag on well into 2027 or even longer. But this isn't just another recession. This is about a crisis starting in the US Treasury market. That's the bedrock of global finance. It sets the price for everything, from your mortgage to corporate loans to your retirement savings. When the Treasury market cracks, the entire financial system starts to crumble. In this video, I'm going to walk you through the 4 inevitable phases of this coming Treasury crisis. I'll show you why we're already deep into phase 2 and why the Fed's recent actions are unto solution. They a quiet confession that they're losing control. Forget fuzzy forecasts based on opinion. This is about a 50-year flawless track record, so let's break it down. The yield curve simply compares short-term interest rates to long-term ones. Normally, long-term rates are higher. But when they flip and short-term rates become more expensive, it's called an inversion. Since 1968, every single time this has happened, a recession has followed within 6 to 24 months. It's not a coincidence. It's basic mechanics. Banks make money by borrowing cheap short-term money and lending it out long-term for a higher return. When the curve inverts, that profit model gets crushed, lending freezes up, businesses can't get loans to expand. Consumers can't get credit. This leads to layoffs and a drop in spending, kicking off the recessionary cycle. This process has been grinding away for 21 months now, a longer period than any other except for the one leading up to the Great Recession. But what makes this time even more dangerous? The Fed's gigantic balance sheet. After years of printing money through quantitative easing, it swelled from less than $1 trillion before 2008 to a peak of $9 trillion. In 2022, they started quantitative tightening, trying to suck that money back out of the system. This sent yields soaring. The 10-year Treasury jumped from under 4% to 4.5%, and the 30-year went over 5%. It revealed a terrifying truth. The market can't function without the Fed's life support. And now, as of December 1st, they've quietly paused that tightening. Why? Because the system is cracking. Bank reserves have plunged to $3 trillion. Interbank lending rates are jumping above the Fed's target. The banks are clinging to their cash. Liquidity is drying up fast. Many experts now predict the Fed will have to restart quantitative easing money printing in the first quarter of 2026, not to stimulate growth, but to prevent a complete meltdown of the Treasury market. It's an admission that their plan to return to normal has failed. The system is hooked on artificial stimulus. Yet the Fed is trapped. Inflation is still stubbornly above their 2% target. Government deficits are exploding, and the national debt is threatening the dollar's status. They can't slash rates without making inflation worse. They can't restart the money printer without admitting defeat. And they can't keep tightening without causing a crash. The people on the front lines see it coming. A recent survey showed that 84% of manufacturing executives are preparing for a recession in 2026, with half seeing it start as early as 2025. They're looking at their raw order data, not just theories and the insiders. They're getting out. Warren Buffett is sitting on a $300 billion cash pile. Jeff Bezos just dumped $13 billion of Amazon stock. Mark Zuckerberg has been selling billions in Meta shares. They're all preparing for asset values to plummet. When the Treasury market malfunctions, borrowing costs skyrocket for everyone. Mortgages become unaffordable. Businesses can't get funding. Governments struggle to operate. Credit cards get frozen. It's a cascading failure. Let's look at the 4 phases. Phase 1 began back in October 2022 when the yield curve first inverted. It was subtle. Credit started tighten quietly. Smart companies locked in their financing and built up cash reserves. This phase lasted about 18 months, until March 2024. The lingering effects of all the Fed's money printing delayed the inevitable cracks. Now we are in phase 2. This is where Treasury auctions start to fail. We're seeing weak demand, meaning fewer buyers are showing up. Primary dealers are being forced to buy up the unsold bonds, and foreign buyers are backing away. Banks, especially regional ones, are feeling the squeeze. Many of them are overloaded with commercial real estate loans, where empty office buildings and retail spaces can't generate enough income to cover their debts. The Fed's pause on tightening is just buying time. The inversion is still in place, credit is still shrinking, and the gears of recession are turning. Phase 3 is what I see coming in late 2025 or early 2026. This is where Treasury auctions will outright fail. We'll see extreme volatility with yields swinging wildly, like when the 30-year yield briefly shot to 5%. The Fed, no longer the buyer of last resort, will expose just how fragile the market is. Supply will overwhelm demand. Yields will spike, which means bond prices will crash. A 1% rise in yields can wipe out 8 to 20% of a bond's value. Banks, insurance companies, and pension funds will see massive losses on their portfolios. Remember Silicon Valley Bank in 2023? It collapsed because rising rates destroyed the value of its bond holdings, triggering a bank run. More will follow, trapped with losing assets they can't sell without realizing catastrophic losses. That brings us to Phase 4, the detonation. By mid-2026, the recession will hit with full force. Forecast models are already converging on this. The New York Fed's model gave it a 26.5% chance back in October. JP Morgan is at 40%, and Moody's is near 50%. The Fed will be forced to flood the market with liquidity, maybe $35 billion a month, but it will be too little, too late. Doing this while unemployment is still low and inflation is sticky will cause a massive political backlash. Congress will hold hearings. The media will question their credibility. Global investors will doubt their sanity. The Fed's reputation will be shredded. This is when the real-world pain intensifies. Manufacturers will cut production and lay off workers, creating a self-fulfilling prophecy. And then there's the commercial real estate time bomb. Over $2 trillion in mortgage are coming due, needing to be refinanced at much higher rates, maybe 7 to 9%. This could cause property values to fall by 40 to 60%, leading to mass defaults. This will slam the regional banks, which hold about 40% of their portfolios in this sector. It will be a repeat of the 2023 bank failures, but on a much larger scale. Local credit will evaporate, and that crisis will snowball into a national one. The clock is ticking. The mechanics of the yield curve are unstoppable, and the Fed is cornered. Don't let yourself be blindsided. The time to prepare is now, not when the crisis hits. Arm yourself with this knowledge. Thanks for watching. If you found this breakdown valuable, please subscribe for more unfiltered analysis. Share this video to wake up others, and most importantly, start taking steps to safeguard your finances today. Because when 2026 arrives, preparation will be the only thing that separates the survivors from the casualties.